Welcome everyone to another episode of Finance. We couldn't post this weekend, but we're going to post in an unusual schedule today. Today we're going to talk about not a trend or an investment topic, mostly something about education, how we can be a good macro investor, and some tools that we can use. So don't forget to subscribe before we start. So we're going to talk about macro investment today. Some of the really good books that I recommend are Pragmatic Capitalism, Inside the House of Money, and Principles for Dealing with the Changing World Order. It is really important to understand how money is created, how money flows, and how money actually travels the whole system. Because then you can see how it moves in the society and in the economic and in the financial markets. Without understanding how money is created, how it's flow, how it's used, it's really hard to see inflows and outflows between asset classes that at the end are the ones that provide the return. So Pragmatic Capitalism is a really good book because it talks about how money is created and the flow of money. And then you can separate the creation of money and how it works in the system with your own emotions in money. So at the end of the day, money is money. It just gets transferred from the impatient to the patient, from chasers to the investors. But if you understand well how the cycles work, then you're going to be able to remove that emotion. So this book really helps you to understand how the money process works. Then another really good book, now that you have your base in the monetary system really well, is Inside the House of Money. It's a series of interviews to different hedge fund managers, and they really talk about risk management from their experiences, which is really important, right? If you are listening and reading about really good investors and people that deal with tremendous amount of pressure to give returns and the ways they achieve those success, you can learn a lot. So this is a really good book as well. And the third one, now that you have the big picture, is the Principles for Dealing with the Changing World Order from Ray Dalio. It basically talks about the long-term view on the economies and how credit cycles change the short term. By credit cycles, we mean when credit's tight, when there is abundance of money in the system to be lent because the society and the economy is going and we think there's going to be growth, so everyone is optimistic. There's opportunities there, but also when credit's tight, when everyone thinks it's the end of the world or something bad is going to happen or we are not sure about, then money gets contracted because we better save that money from everywhere, institutions, banks, to the individuals. Then the economy also has some tailwinds, but there is also opportunity when credit cycles are tightened. So really 3 good books. So now you understand money creation, money risk management, and credit cycles, then you can actually go and look at different correlations between assets. So the 2 most important principles is to have a test indicators with statistically significant values that you know that these indicators actually have an influence or a relation or a significant value to other variables. For example, we have been talking in these episodes about lumber, how lumber is a testing indicator for growth and for economic movement. That could be one. So then you need to find those indicators that really help. And the second one is to have the volatility measures to capture cycle anomalies. Because we can understand, we can have some leading indicators, but if we don't know if there is an anomaly, if it's not moving the way it should move. For example, when George Soros broke the Bank of England, he understood very well that the pound was not working correctly against the other European currencies. So he saw an anomaly based on also volatility. When he spot that, then he makes his bet. And that could be in any single asset class. As you can see, for example, The Big Short, which is a movie, not an investment documentary, you can also see there is a bubble. There is an anomaly on how the prices of houses were increasing without any underlying value. So you can see the anomaly and then you can take advantage of that one. And for For this, for example, test indicators could be growth, labor, market, inflation, and housing. And lumber is a clear indicator of this, the price of lumber. And then you also need the volatility measures to capture cycle anomaly. So Michael Gade, he actually came up with the gold to lumber ratio or the lumber to gold ratio. If gold to lumber ratio is leading, then you should be in risk off. So you shouldn't take too much risk going to treasuries. If lumber is leading gold, means economic growth is coming up. So then you should go risk on. So going to the more risky assets like equity markets. And then you need a volatility adjusted dashboard. Now, why adjusted? Because a 2% move in treasury rates is way more significant than a 2% move in equity markets, right? Equity markets every day and now can move 1, 2, 3%, which 3% is kind of high, 2% is a little high, but still, you can tolerate that. But when you have bonds or treasuries moving 2.5, 3%, then something is really going to happen because those securities should not move as much. So you need that volatility adjusted to look at all asset classes and look at the anomalies. So for example, if you look at the S&P 500, here is the graph of the prices for the last year. So 1 year since May 2022, and down here you can see the volatility. You can see in the last days the volatility is really low for the S&P 500, and if we see here the implied volatility, we are at the lowest 1% for the 52 week, so for 1 year, lowest 2% for half a year, so for 26 weeks, and lowest 5% of volatility for the last 13 weeks, which will be 1 quarter. So extremely low volatile environment for the S&P 500. Could be an anomaly, could be something could move soon. So then we can here see and spot that maybe, hey, volatilities adjusted are really not moving how they're supposed to move based on the trend that we have seen in the last years, so we can take advantage of this. So ideas arise from a breakup in long-standing correlations between different indicators, because that's where the anomalies come. So when one is able to regress the returns of all the most relevant macro variables that you pick against each other using probably a 5-year history in order to find strong long-term correlations and then identify breaking habits. For example, in 2022, correlations between bonds and stocks were at 0.80 when the rolling correlation for the last 5 years is around 0.40. We understand bonds are hedge, or not a hedge, diversification against stocks, but when they're moving together, everything is going down, then there's an anomaly there. So then a lot of people could have taken advantage and saw that and be short bonds and stocks, or do a trade that actually can capture that anomaly. So I hope this is helpful, but I definitely recommend those 3 books and start looking at macro indicators and try to build your own returns, the regression returns for all the most relevant variables so you can see the anomalies. And if you don't like any of this, you prefer just to be lazy, there's always index funds that potentially for you, the retail investor, could help just to provide good returns in the long term.